Alright guys, my name is Shervin. Welcome to my channel. In this video, we're going to be talking about how you should be diversifying your investments. Now, the main purpose behind diversifying your investments is that you protect your investments by essentially not putting all your eggs in one basket. But that said, depending on who you ask, you're going to get different answers as to how you should be diversifying your portfolio. For example, renowned investor and one of the faces of Shark Tank, Kevin O'Leary, has a very systematic way of diversifying his investments, and he suggests that you should do the same. Now, his plan essentially boils down to not putting more than 20% of your net worth into any one specific asset class. Now, some examples of asset classes would be stocks, bonds, cryptocurrency, real estate, commodities, cash, etc. Also, his plan includes not putting more than 5% of your net worth into any one specific asset. Now, this could include any one specific stock, one specific bond, one specific property, or even one specific cryptocurrency. Now, the main benefit of this plan is that you're gaining exposure to a lot of different assets among a ton of different asset classes, which means that if one of your investments go wrong, or even if the market crashes for one of your asset classes, that's only a small percentage of your portfolio, and the rest of your portfolio will still be fine. Now, that being said, there are some other investors who completely disagree with this way of thinking, and one example of that would be Warren Buffett. Now, according to Warren Buffett, instead of trying to widely diversify your entire portfolio, what you should really be doing is finding 2 or 3 great investment opportunities that have a relatively low risk and a relatively high return, and just putting all your investment dollars into those 2 or 3 investments. Now, the logic behind this being that if you can find 2 or 3 great investments that have a relatively low risk and a relatively high return, why would you put your money anywhere else that's going to either give you a lower return or have the same return for a higher risk? In fact, to quote the man himself, diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. So where does that leave us? Do we go the Kevin O'Leary route of making sure we wildly diversify our portfolio so that we are protected against any mishaps? Or do we go with more of a Warren Buffett approach, where we just pick 2 or 3 great investments and just stick to that without worrying too much about diversification? Well, the truth, as it often does, lies somewhere in the middle. Now, in order to find the best method for investing, we're going to take a look at a great study done by Strategic Advisors Incorporated, where they compared an all-stocks portfolio with a diversified portfolio, and they saw how each of those portfolios would have performed during the 2008 market crash and the subsequent recovery all the way up to 2014. Now, according to this data, during the actual market crash from January 2008 all the way to February 2009, the diversified portfolio suffered a far smaller loss due to its diversification. Now, this is mostly due to the way different investments react to the way the market is behaving. Now, when the market as a whole is going up in value, which is also referred to as a bull market, that also means that equity investments such as stocks also as a whole go up in value. Now, keep in mind, this doesn't mean that every single stock will go up in value. It just means that more stocks will go up in value than those that will not. Now, on the other hand, fixed income investments such as bonds will just keep giving you a small but consistent amount, regardless of the market going up. But on the flip side, when the market as a whole is going down, that means that equity investments such as stocks will end up also going down as a whole as well. But on the other hand, bonds will keep giving you that same amount of small but consistent return regardless of the market going down. Now again, keep in mind, this doesn't mean that every single stock will go down in value. It just means more stocks will go down in value than those that will not. So when the market as a whole is going down, which is also referred to as a bear market, what ends up happening is that investments with fixed incomes such as bonds will end up going up in value because they are still giving you that same amount of small but consistent return regardless of the market as a whole going down and all other investment types being in dire need of recovery. And now this is why, in the example that we saw, the diversified portfolio that also included investments such as bonds ended up seeing a far smaller loss during the 2008 crash compared to the all stocks portfolio. But where things get interesting is that from February 2009 all the way till 2014 during the recovery period of the market, what ended up happening is that the all-stock portfolio ended up outperforming the mixed portfolio by quite a bit. And when you take a look at the entire period from 2008 to 2014, you can see that the all-stocks portfolio actually ended up beating out the diversified portfolio by a small margin. So what does that really mean when it comes to the way we are going to invest? Does that mean that we should diversify or we shouldn't diversify? Now, what this study illustrates is that equity investments, such as stocks, are much better investment options for the long term compared to fixed income investments, such as bonds, which are much better investments for diversifying your portfolio for not sustaining big losses in the short term in the event of a market crash. So what this means for you is that if you're a younger investor, particularly someone in their 20s or 30s, you should be focusing more on long-term investments as you have much longer left until your eventual retirement and the eventual end of your life. Now, this means purchasing stocks and equity investments alike and not really bothering with bonds and fixed income investments, as you don't really need the protection for the short term, as you should be aiming for investing for the long term. Now, on the other hand, when you get into your 40s and 50s, you want to make sure to start rebalancing your portfolio by including more fixed income assets such as bonds in order to protect yourself against short-term losses in the event of a market crash. Because at that point, you're getting closer and closer to your eventual retirement and closer to the eventual end of your life. So you want to make sure you protect yourself against any short-term losses. Alright, that's about it for this video. Hopefully you guys enjoyed that. Now, this video took a lot more research and filming than usual because I feel like this is a very important topic, which also has a lot of disagreements over. So I wanted to make sure I get all the nuances right. So if you are feeling extra generous today, maybe drop a like or leave a comment down below. It would really help me out with the YouTube algorithm and I would really appreciate it. But with that said, thank you guys so much for watching and I will see you in the next video. Cheers.